The notification arrives at 6:47 in the morning. Not a phone call, not a letter. A single push alert from your banking app, the same app you have checked every morning for the last 4 years, with the quiet confidence of someone who believes they have built something real. You tap it open. Your checking account, the one with the emergency fund, the one with the tax installment money, the one your accountant specifically told you to keep untouched, shows a balance of 0. Not low, not overdrawn. 0. You blink, you scroll, you hit refresh. 0. And somewhere in the fine print of a 47-page document you signed on a Tuesday afternoon in a mortgage broker's office 3 years ago, a clause you never read, never questioned, and never understood, just legally transferred every dollar you own to cover a debt you thought was being managed. This is not a glitch. This is not fraud. This is the offset clause, and it just executed you. Welcome back to Canada Property Watch. In our last investigation, we pulled back the curtain on how banks are using HELOC freeze orders to trap over-leveraged homeowners inside properties they can no longer refinance and can no longer sell. Before that, we documented the CRA's algorithmic audit sweep targeting landlords who collected cash rent and reported phantom losses. Today, we go deeper. Today, we talk about one of the most misunderstood and most devastating legal instruments sitting inside your banking agreement right now. The offset clause, also called the right of set-off, and by the time this investigation is over, you will never look at your bank account the same way again. Let us start with the basic architecture of what just happened to the person in that opening scenario, because this is not a hypothetical. Versions of this situation are playing out across Canada right now, specifically in Ontario, British Columbia, and Alberta, where the intersection of rising mortgage arrears, variable rate shock, and multi-property investor portfolios is creating the exact conditions under which banks activate this legal mechanism at scale. The offset clause, known formally in Canadian banking law as the right of set-off, is a contractual and common law right that allows a financial institution to apply funds held in any account you own at that institution against any debt you owe to that same institution. Read that sentence again slowly. Any account, any debt. The bank does not need a court order. The bank does not need to notify you in advance. The bank does not need to wait for you to miss a payment. If the institution makes the legal determination that your debt is in jeopardy, they can reach across every product you hold under your name at that bank and pull whatever they need to cover the exposure. Your checking account, your savings account, your TFSA in some specific circumstances, your business operating account, all of it becomes potential collateral the moment you sign their agreement. This is where the amateur investor made their first catastrophic miscalculation. During the boom years between 2019 and 2022, a specific type of Canadian real estate participant became dominant in markets like Brampton, Mississauga, Surrey, and Kelowna. These were not sophisticated institutional investors. These were salary earners, small business owners, and first-generation wealth builders who had watched property values double and concluded that leverage was the same thing as strategy. They concentrated every financial product they owned inside a single major bank: their primary mortgage, their HELOC, their rental property mortgage, their small business line of credit, their personal checking, their savings, all under one roof. One login, one institution. They did this because it was convenient, because the mortgage specialist offered a slightly better rate for portfolio consolidation, because it felt powerful to have a single dashboard showing 7 figures of combined real estate exposure. What they did not understand is that consolidation of that kind is not a strategy. It is the construction of a legal trap, because every single one of those products is governed by that institution's master banking agreement, and buried inside that agreement, in language that has been legally refined over decades of Canadian banking jurisprudence, is the right of set-off. They handed the bank a kill switch over their entire financial life and called it portfolio management. Stay with me, because this next part changes everything. Now, let us talk about the trigger mechanism. Because the offset clause does not activate randomly. There is a specific sequence of events that banks use internally before they execute this instrument, and understanding that sequence is the difference between having a warning and waking up to a zero balance. The first trigger is what institutional risk departments call account behavior divergence. This is the point at which your actual financial behavior begins to statistically deviate from the profile you submitted at the time of application. When you applied for that investment property mortgage, you submitted documentation showing a certain level of rental income, a certain debt service ratio, a certain liquid asset base. The bank's internal risk algorithm runs continuous comparisons between that original profile and your current account activity. The moment those two pictures begin to diverge, rental deposits that stop appearing, minimum payments instead of full payments on the HELOC, irregular salary deposits suggesting employment disruption, the account is flagged, not by a human, by a system, not an automated surveillance infrastructure that runs every single business day. The second trigger is external market data. Banks in Canada do not assess your creditworthiness in isolation. They cross-reference your property portfolio against real-time market valuation data. When property values in your specific postal code decline past a threshold that pushes your combined loan-to-value ratio above their internal risk ceiling, the flag intensifies. If you bought an investment property in 2021 at peak valuation using a 5% down payment and maximum HELOC leverage, and that property's market value has since declined by 15 to 20%, you may already be in negative equity territory without receiving a single piece of correspondence from your bank. The internal designation for your file has changed. You just do not know it yet. The third trigger is what risk teams call cross-product stress. This is where the mechanics become genuinely terrifying. If you have a variable rate mortgage that has reset upward and you are simultaneously carrying a HELOC balance at prime plus 0.5%, and you have a small business line of credit that you have been drawing on to cover the gap between your rental income and your mortgage obligations, the bank system is watching all three products simultaneously. It is calculating the aggregate probability of default across your entire relationship with the institution. And when that probability crosses their internal threshold, the file moves from the standard servicing queue into what banks internally designate as special accounts or special loans. At that point, a human being, a specialist in recovering institutional exposure, is assigned to your file. And that specialist has tools at their disposal that the average mortgage specialist who sold you your products never mentioned once. The right of set-off is one of those tools, and once a file is in special accounts, the question is not whether to use it. The question is only when and how much. Quick question for you. Has your bank ever mentioned the offset clause to you when you open your accounts? A or B? A, they explained it clearly. B, you have never heard of it until right now. Drop it in the comments. The answer might surprise other people watching this. Let us now examine how this legal execution actually unfolds in practice, because the amateur investor at this stage typically believes they still have options. They believe they can call their mortgage specialist and negotiate. They believe they can sell one property to cover the gap. They believe that because they have not yet missed a payment, they are still in control. This belief is the most expensive financial illusion in Canadian real estate right now. Here is what actually happens. The bank's special accounts team does not call you. Not initially. They conduct what is called an internal portfolio review, which is a forensic examination of every transaction across every account you hold with the institution over a defined look-back period. They are looking for specific patterns. Rental income deposits that are irregular, suggesting potential cash rent arrangements that were not disclosed on the original application. Inter-account transfers that suggest you are robbing Peter to pay Paul, moving money from your HELOC into your checking to make the HELOC minimum payment, which is a classic sign of a debt spiral that borrowers routinely attempt to conceal from their lenders. Large cash withdrawals that cannot be reconciled with normal business activity. Any of these patterns gives the institution additional legal standing when they eventually activate the offset mechanism. Because in a subsequent legal dispute, the bank can argue that they had documented evidence of financial misrepresentation and deteriorating creditworthiness before they acted. That documentation is their legal armor. When the internal review is complete and the decision is made to execute, the bank moves with a mathematical precision that is genuinely terrifying to observe. And they do not execute the offset at the moment of maximum drama. They typically execute it at a moment of maximum effectiveness. Often, this is immediately before a large deposit is expected: a rental payment, a payroll deposit, a tax refund. They know your deposit patterns because they have been watching your accounts for months. The funds hit your account, and within hours, sometimes within minutes, the offset mechanism pulls those funds against the outstanding debt. The account returns to zero. You have lost not just money, you have lost the operational capacity of your financial life. You cannot make your mortgage payment. You cannot pay your property taxes. You cannot cover your insurance premium. A single legal clause has not just taken your money, it has detonated your entire financial infrastructure simultaneously. Now, let us address the question that every person watching this is asking internally right now. Is this legal? The answer is yes, and that answer should terrify you. The right of set-off is a well-established doctrine in Canadian common law and has been consistently upheld by Canadian courts, including the Supreme Court of Canada. Financial institutions are required under their terms of service agreements to disclose the existence of this right. The disclosure is there. It is in the agreement you signed. It is in the terms and conditions you were provided. The problem is not that banks are doing something illegal. The problem is that the legal system has created an instrument of such disproportionate power that a sophisticated institution can use it against an unsophisticated borrower with essentially zero operational friction. It's no court order, no 30-day notice, no mediation requirement. Execute first. Litigate later if the borrower complains. And here's the part that the people who believe they are safe need to understand. The offset clause does not only affect investors who have done something wrong, it can affect anyone who has concentrated their financial life inside a single institution and finds themselves in a position where that institution determines their risk profile has changed. You do not have to have committed fraud. You do not have to have lied on your application. You simply have to be underwater or approaching underwater in a market that has moved against you. And in 2024 and 2025, with mortgage renewals across Canada, repricing at rates between 50 and 100% higher than the original contract rate. The number of Canadians whose risk profiles have materially changed inside their bank's internal system is not small. It is structural. Here's what I want you to do right now. Comment below with ME and the city you own property in. Just ME and your city. Because the next part of this investigation gets very specific about which markets are seeing the highest concentration of offset-related account actions right now. Let us talk about the collateral damage. Because the execution of the offset clause against one over-leveraged investor does not stay contained to that one financial life. It creates a chain reaction that reaches into the equity of every property owner on the same street, in the same building, in the same postal code. When an investor's account is zeroed out through the offset mechanism, the sequence that follows is mechanical and merciless. The mortgage goes into arrears because the funds that would have covered the payment have been seized. The bank initiates power of sale proceedings under Ontario law, or judicial foreclosure in provinces that operate under that framework. The property goes to market through a forced sale process that is explicitly designed not to maximize the sale price, but to recover the bank's outstanding principal and costs in the shortest possible time frame. This means the property sells at a discount, sometimes a significant discount. In a condominium market in Toronto or Vancouver, where prices are already under downward pressure, a power of sale unit hitting the comparables can move the average sales price for an entire building, not by a little. The forensic data from previous cycles shows that forced sales in concentrated buildings can suppress comparable values by 8 to 12% within a 90-day window. Now multiply that across a scenario where multiple investors in the same building or the same subdivision are simultaneously facing offset-triggered arrears. Because the same macro conditions that pushed one variable rate investor into the offset trigger zone, rate resets, declining rental income, rising operating costs, are pushing every other investor in the same position simultaneously. This is not a one-by-one execution. This is what the institutional risk literature calls a correlated default event. And when correlated defaults hit a localized real estate market, the innocent owner-occupier who has done everything right, who bought within their means, who has a fixed-rate mortgage, who never speculated, watches their equity vaporize through no action of their own. Their neighbors' greed and their bank's legal mechanism have just stolen years of their financial progress. This is the mechanism that is never discussed in mainstream coverage of the housing market. The conversation is always about rates, about affordability, about supply. It is never about the legal infrastructure that allows a single financial institution to simultaneously liquidate an entire portfolio of properties in a localized market and crush the equity of every surrounding homeowner in the process. Canada Property Watch is the only channel that documents this at the level of actual legal mechanics, and that is why what you are watching right now matters. But let us now destroy the most dangerous myth in Canadian real estate: the idea that handing back the keys solves the problem. Because for an investor whose properties were acquired with misrepresented income documentation, or whose rental arrangements were never disclosed to the lender, handing back the keys is not a resolution. It is the beginning of a permanent legal execution. When a property goes to power of sale and sells for less than the outstanding mortgage balance, the difference between the sale price and the outstanding debt is called a deficiency. In Canada, with limited exceptions in specific provinces, the lender has the right to pursue you personally for that deficiency. This is not a negotiating position. This is a legal judgment that can be registered against your personal credit, against future employment income, and against future assets you acquire. The bank does not forget. The judgment does not expire in a way that meaningfully protects you. A deficiency judgment can follow a borrower for years. It surfaces every time they apply for a mortgage, every time they open a new business account, every time a credit check is run for any significant financial transaction. The idea that you can walk away from a failed investment property and rebuild in 3 years is a fantasy that the banking system has specifically engineered out of existence. And for the investor who committed actual misrepresentation, who inflated rental income on their application, who used a second position lender to cover their down payment without disclosing it to their primary mortgage provider, who had a friend sign a fake lease, the legal consequences are categorically worse. A deficiency judgment becomes the least of their problems because the bank's forensic examination of their file, the same examination that preceded the offset execution, has already documented the misrepresentation, and that documentation does not stay inside the bank. Under Canada's anti-money laundering reporting obligations, financial institutions are required to report transactions and account behaviors that suggest proceeds of crime to the relevant authorities. The file that began as a credit risk assessment has the potential to become the foundation of a regulatory referral. The offset clause was not the end of the story, it was the opening act. This is exactly where we are headed in our next investigation. We have been tracking a specific pattern. These now landlords who collected unreported cash rent for years, who are now being identified through a combination of bank account analysis, CRA, rental income matching, and tenant whistleblower reports. The numbers we have uncovered are staggering. The legal exposure is unlike anything we have documented on this channel. If you are a landlord in Canada and you have ever collected a single month of cash rent that you did not report to the CRA, next week's video is not optional. It is the most important thing you will watch this year. Vote right now. Next video: A. CRA cash rent audit mechanics, or B. Bank power of sale, fire sale data by city. Drop your vote in the comments. A or B, because whichever one wins, the one after it is already written. And neither of them ends well for the people being investigated. If you have made it to this point in this investigation, you are not a casual viewer. You are someone who understands that the Canadian real estate market is not having a correction. It is undergoing a systematic legal and financial restructuring that is transferring wealth from the over-leveraged to the institutional at a scale and a speed that has no modern precedent in this country. The offset clause is one instrument in that transfer. It is not the only one. It is not even the most powerful one, but it is one of the most invisible, and invisible instruments are the most dangerous kind. Subscribe to Canada Property Watch. Turn on every notification, because this channel does not speculate. We document, we source. We trace the legal mechanics from the fine print to the bank account to zero, and we will keep publishing until every person in Canada who owns property understands exactly what is in the agreement they signed. The offset clause was always there. The bank has always known it was there. Now you know too. The question is what you do with that knowledge before the notification arrives.